Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Monday, August the 3rd, 2026, and we've got a packed show this morning. A broad equity rally fueled by geopolitical relief and a blockbuster earnings season, plus the ISM manufacturing print dropping today and Friday's jobs report looming large at the end of the week. Let's get straight into it. Lizzie, futures are pointing firmly higher. Nasdaq up 0.8%, S&P up 0.6%. What's the single biggest driver behind today's move?
Morning, Robert. The single biggest catalyst this morning is President Trump calling off the planned military strike on Iran and pivoting back to diplomatic talks. And that decision is doing a lot of heavy lifting across markets simultaneously. It's knocked Brent crude down over 5% to around $83 and change. It's relieved a key inflation pressure point that had been complicating the Fed's calculus. And it's landing right in the middle of what has been a genuinely strong earnings season. So everything is pointing in the same direction at the open this morning.
How significant is that oil drop for the broader equity rally? Does it actually move the needle on inflation meaningfully?
It's significant in the near term, and the market is treating it that way. But 1 week of falling crude doesn't resolve the Fed's inflation problem on its own. What it does do is remove an acute risk premium that had been baked into energy prices, and with OPEC also agreeing to bump production by roughly 188,000 barrels per day, there's a credible case that the relief could have some staying power, which is why you're seeing it translate so directly into equity enthusiasm this morning.
Q2 earnings have been exceptional. Morgan Stanley's Wilson is citing an 86% beat rate, a 5-year high, with S&P EPS growth running at 29%. Are we at a point where the earnings story is strong enough to override the rate headwind?
For right now, the earnings story is winning that argument, and the numbers genuinely support the optimism. Wilson's figures show 86% of companies beating estimates at a 5-year high, with 29% EPS growth. And separately, Zacks is tracking blended year-over-year earnings growth closer to 47%, with an 83% beat rate across the broader index. So whichever lens you use, the picture is solid, with cloud strength from Microsoft, Amazon, and Alphabet, all reinforcing that AI infrastructure spending is producing real commercial returns, rather than just balance sheet promises, though with Treasury yields sitting near 4.73%, and the 30-year having briefly topped 5% for the first time since 2007, the rate headwind is very much still in the room.
Wilson is also calling for a rotation away from chip stocks toward quality names, insurance, healthcare equipment. Is that rotation actually showing up in the tape yet?
It's more forecast than confirmed tape action at this point. What we are seeing is a Goldman Sachs momentum basket that's down 35% from its June peak, which tells you the momentum unwind in high-flying names is real, but the deliberate rotation into insurance and healthcare equipment as a quality destination is still more thesis than established trend. And Wilson himself is framing it as what should happen next, rather than what's already clearly underway.
Bristol Myers and AstraZeneca are reportedly in talks on a $400 billion merger. BMI surged on the news. What do we know, and how rare is a deal at that scale in pharma?
BMI shares have surged sharply on the report, and the numbers here are striking. AstraZeneca was carrying a market cap of around $264 billion, and Bristol Myers around $133 billion. So a $400 billion deal would rank among the largest pharmaceutical mergers ever recorded, and for a sector that uses M&A as a pipeline diversification tool, a transaction of this magnitude would represent a structural reshaping of the entire large-cap pharma landscape. So traders are right to take it seriously even at the preliminary talk stage.
Palantir reports after the bell tonight, 85% revenue growth last quarter, but shares are down over 26% year to date. What's the setup heading into that print?
The setup is genuinely compelling because you have a company that delivered extraordinary growth last quarter, running into a stock the market has re-rated lower on concerns about rising AI competition, eating into its differentiation. So tonight's report is really a test of whether the revenue trajectory has held up against that competitive pressure. If Palantir can show sustained top-line momentum and defend its margins, you could see a sharp reversal in those year-to-date losses. But the bar is high, given how much the stock has already given back.
Steve, ISM manufacturing PMI is out at 10 a.m. Eastern this morning. Forecast is 54.0, up from June's 53.3. What would a print at or above that level signal about the broader economy?
A reading at or above the 54.0 consensus this morning would be a constructive signal for the broader economy because it would confirm that the manufacturing expansion is not only sustained but actually accelerating from June's already solid 53.3 reading. Any reading above 50 signals expansion, so continued territory well above that threshold, would indicate the industrial side of the economy is holding up despite elevated borrowing costs. And that matters directly for the Fed's calculus because a resilient manufacturing sector combined with a still tight labor market makes the case for near-term rate cuts considerably more difficult to justify, which feeds right into the rate hike probability conversation that's been building all month.
What else is on the economic calendar this week that traders should be marking?
It's a very data-heavy week, and the sequencing matters quite a bit. Tomorrow, we get the trade balance and JOLTS job openings for June. JOLTS previously came in at 7.54 million, and the forecast is for a modest dip to 7.5 million, which would still represent a reasonably tight labor market. Wednesday brings the ADP employment report for July, where the forecast is 70,000 private payrolls added, down from June's 98,000, and that will set the tone heading into Thursday's initial jobless claims. Last week's print came in at 197,000, better than the 200,000 forecast, and this Thursday's consensus is 201,000. The marquee event is Friday's July non-farm payrolls report, where consensus is sitting at 83,000. That's up from June's very soft 57,000 print against a forecast of 110,000 at the time, so the labor market has been decelerating meaningfully, and Friday's number will be closely watched by everyone trying to read the Fed's next move.
Given the Fed is already leaning toward a hike with 3 presidents dissenting, what threshold does payrolls need to hit to really move the needle on September rate expectations?
Given that 3 Fed presidents already dissented in favor of a 25 basis point hike, and the CME FedWatch tool is showing roughly a 65% probability of a September increase, Friday's NFP print needs to either meaningfully surprise to the upside to lock in that hike or come in substantially below expectations to give the doves any real ammunition. A print above 100,000 would likely solidify the September hike probability further, while anything below 50,000 would represent a continuing deceleration trend that might give markets reason to question whether the Fed can tighten again into a softening labor market. And that tension is really the central question hanging over all of this week's data releases.
Lizzie, over to crypto. Bitcoin is slipping under 63,000 even as equities rally and oil sells off. What's going on there?
The divergence from macro is the telling part of this story. You have Nasdaq futures up nearly 1%, Brent crude down over 5%, Treasury yields easing slightly, and Bitcoin is still sliding, which tells you the selling pressure is entirely internal to the crypto market, rather than driven by any macro factor, and the culprit is the cold card hardware wallet exploit, now entering its 5th day with losses topping $114 million across nearly 4,600 addresses, with Galaxy Digital's Alex Thorne warning that a 4th wave of coordinated attacks is likely, keeping a genuine cloud over crypto sentiment, even as everything else catches a bid this morning.
How badly does an event like this dent confidence in self-custody more broadly?
It's a serious blow because self-custody is foundational to the Bitcoin thesis for a large segment of the holder base. The entire philosophical argument is not your keys, not your coins, and when a widely trusted hardware wallet like Coldcard turns out to have an exploitable vulnerability that has drained over 1,000 Bitcoin across multiple attack waves, with on-chain analyst Willy Woo putting recovery odds at just 20 to 40%, that fundamentally shakes the confidence of people who chose hardware wallets precisely to avoid custodial risk. And the practical consequence is already visible with holders reportedly moving assets back onto centralized exchanges, which is the opposite direction the space has been pushing toward.
Kevin O'Leary has dumped all 27 of his altcoin positions and cut his crypto weighting from 24% to 14%, now favouring power infrastructure. Signal or noise?
It's worth paying attention to for a couple of reasons. O'Leary isn't the only one making this move, and his framing around power infrastructure being the real AI and Bitcoin mining play is directionally consistent with where institutional thinking has been drifting, plus the Coinbase Premium Index being negative for a record 76 consecutive days, and spot Bitcoin ETFs recording $265 million in single-day outflows, suggests this isn't just one person's repositioning, but part of a broader capital rotation away from altcoins toward adjacent infrastructure themes. And for the major coins specifically, Ethereum has been trading around 1,842, and Solana posted a modest gain of around 2.6% over the past 24 hours. But both are navigating the same self-custody confidence problem weighing on the entire sector right now.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.